welcome back to another episode of Policy and Profits. I'm Antony Esposito, founder and CEO of Ascalon 6 Capital. I am here with my good friend E.J. Antony, chief economist at the Heritage Foundation. E.J., great to have you back. Great to see you, my friend. How is the week going and where are you at?
Yeah, I think it's been another busy one, another round of data dumps. Some of this is we're still dealing with that whole backlog from the government shutdown and everything. So in some cases, you're getting these reports where they're covering 2 months instead of one, right? But whatever the case, yep. It's been another busy week with lots of numbers coming in.
Yeah, it's definitely been busy. We have been. I normally like to say we're winning at life. I would say that we are winning, but it's becoming more of a struggle. So. The month has been insane as far as the markets, the headlines, the news. One thing, we'll get to the markets in a second, and we're going to carry through on that weekly chart for the S&P 500. I think it will prove to be one of the most valuable charts that we've looked at, and that's why we'll continue to roll through. One item that I saw this week is everyone's favorite mayor, Mayor Mamdani, who is, I don't know if he's stuck between a liberal, a leftist, a fascist, an Islamist. I don't know where he's at. However, he did make a statement about their budget. He's having some trouble. He's about 2 hours into the administration, and they're already out of money. I want to play that, and I have a very specific, all kidding aside, very specific question for you about this, which is a national question, but I'm going to use him as the peg. So let's listen to that, and then I have a good question for you, I think.
For those who have watched budget after budget, it is tempting to assume that we are engaging in the same dance as our predecessors. Let me assure you, nothing about this is typical. That's why our solutions won't be either. There are two paths to bridge this gap. The first is the most sustainable and the fairest path. This is the path of ending the drain on our city and raising taxes on the richest New Yorkers and the most profitable corporations. The onus for resolving this crisis should not be placed on the backs of working and middle-class New Yorkers. If we do not fix this structural imbalance and do not heed the calls of New Yorkers to raise taxes on the wealthy, this crisis will not disappear. It will simply return, year after year, forcing harder and harsher choices each time. And if we do not go down the first path, the city will be forced down a second, more harmful path. Faced with no other choice, the city would have to exercise the only revenue lever fully within our own control. We would have to raise property taxes.
Okay, so two things jump out at me then my question. The first one is that the wealthiest New Yorkers are a drain on the city. Okay, that's insane because they're the ones that are paying a bulk of the taxes, and that the wealthiest New Yorkers are not hardworking people and don't deserve to be treated fairly. So it reeks with socialism. It reeks with a severe lack of understanding of economics 101, and it is extremely dangerous as a native New Yorker. Somebody who born and raised, worked on the floor of the stock exchange for 17 years, worked Midtown for another 5-10 years, was there 9/11, was there, even during the bombing in 92. Like this is insane. Here's my question. We've seen some wins under President Trump, and we're digging our way out of a hole. We're cleaning up in aisle 7. What we're seeing, and I'd like you to talk about some of the accomplishments and what that trajectory is now looking like as we turn up from the lows of the Biden administration. Could local and state policy like this, local and state government, could their policies be so bad, so detrimental, that they'll actually undercut the benefits that the Trump administration on a national level, the benefit of those national policies and international policies will create? So will the trajectory get cut short because of morons like Mamdani?
Anthony, that's a great question. So I guess first, right off the bat, in terms of wins, look what the president has done to right-size government, basically. And for the record, he's had virtually no help from Congress. So this is him throwing the executive order kitchen sink at all the problems, trying to get something done here. Because again, Congress can't get off their tufts to do anything. Between the Democrats who just want to see Trump fail and the big spender Republicans who want to see any kind of cuts fail, he's really facing an uphill battle. That being said, he's accomplished a lot through things like DOGE. They've gotten rid of over 300,000 government workers in just a year. That's incredible. 10% of the workforce, 10% of the bureaucracy is gone. You have to go all the way back to 1966, 6 decades ago, for those playing along at home, to find a lower print in terms of number of federal government workers. It's incredible. The deficit, if you look at the cumulative deficit, or the deficit for the fiscal year to date, so that runs from October to January, it's down 17% compared to the same months from the prior fiscal year. And the reason I think it's very relevant right now is the fact that if you look at the prior fiscal year, those same 4 months, again, it's October to January, those were the last 4 months of the Biden administration. So I think that's a pretty relevant comparison. And you have a deficit that's down 17%. Outlays from the Treasury have barely grown. I think they're up like 2%, maybe just under 2%. And meanwhile, tax receipts are way up because you're growing the economy faster. And so out of a broader tax base, you don't need to increase the rate to still get more revenue, and hence your tax receipts are going up. So all of the net job gains that we're seeing right now in the labor market, they're going to native-born Americans. They're in the private sector, the opposite of what we saw under Biden, right, where it was foreign-born workers getting jobs and it was the government that was growing. Well, let's not forget, January of 2025, that handoff month, if you will, between Biden and Trump, in that month, the private sector actually lost jobs. Private sector wasn't even growing anymore. So private sector had a net loss. Government was the sector, the public sector, which was gaining jobs. So that's, I think, really important. Looking at on the inflation front, the latest inflation reports have all been very, very mild. The let's call it the panic over tariffs was really overblown in terms of consumer price increases. In fact, if you look at the CPI, which obviously went down in the last report, but look at I would say the three main ways that you can remove outliers, Anthony. So that would be core, which obviously removes food and energy, the most volatile categories. But then there's two other ways to remove outliers. You have trimmed mean CPI and median CPI. And those are basically just different ways to varying degrees of taking out the fastest and the slowest growing, or sometimes decreasing, prices out of the index. All three of those metrics are at the lowest level in almost 5 years. So again, really good progress on the inflation front, good progress on the labor market, on right-sizing government. We can go on, but the president, I think, has racked up quite a few wins. Now, getting back to your question, how can state and local governments screw this up? They can do a lot of damage. Let's not forget 2020. That's exactly what happened. The red states reopened their economies. Florida was open for business, right? A big reason why red states have so many more jobs today compared to February of 2020, as opposed to blue states. Some blue states basically have the exact same number of jobs they did 6 years ago now. That's insane. But it's because so many of those blue states, Anthony, I guess to spite President Trump and to really wreck his electoral chances that year, in 2020, they kept their economies closed. They literally made it illegal for you to go to work. They made it illegal for you to reopen your business. And so a lot of business owners said, the heck with this. They packed up. They went to Florida. They went to Tennessee. They went to Texas. They went to places like Utah and even Idaho. Idaho has something like 15% more jobs today than they did 6 years ago. They have been the fastest growing state since the pandemic. And a lot of people don't realize that. But so much of that has to do with the fact that they were one of the most liberal states in terms of opening their economy. Not liberal as in progressive, but liberal as in, I guess you might say, libertarian. In other words, it was, all right, guys, everybody go do what you want. Take what risks you want. Don't take what risks you don't want to take, et cetera. We're not going to do the mask mandates. We're not going to do the vaccine mandates. That really had freedom. Yes, exactly, Anthony. It's a very succinct way to put it. You're right. So those effects are still with us today in terms of that disparity between the red states and the blue states, and who recovered and who did not. And now I think what you're seeing today, to a certain extent, is a repeat of that. Sorry if this is a very roundabout way of answering your question.
This is perfect. This is exactly what I wanted to bring out, and you're doing it.
Okay, so you're looking at states that are basically trying to, I guess you could say, end run the big, beautiful bill. States like Illinois, states like, what's another good one? California, Tim Walz up in Minnesota, all these different blue states are basically trying to find ways to replace that federal revenue that's going to be decreased. They're trying to replace it with higher state taxes. In other words, they're trying to increase your state taxes to match your tax savings from the big, beautiful bill. In other words, it'll just be a big transfer of wealth to those state governments. And because some local governments are basing their, I should say, what state governments say is your tax liability, that is based oftentimes off of the state measures. Now, previously, many states would simply also base your taxable income off of federal metrics. But again, some states are trying to move away from that now to increase your taxes. So it's all a very long-winded way of saying that because of the mechanisms that they're putting in place today, people in blue states are not going to see the same tax savings as people in red states as a result of the different provisions in the big, beautiful bill. And that offset is definitely going to hurt things like consumer spending. It's going to hurt investment. It will, in the long run, hurt economic growth. And so you will see the short-term effects, again, of less consumer spending because people's take-home pay is going to be smaller. But you're also going to see that the long-term effects in terms of slower economic growth, and that's not going to be good either. Now, the one thing that does blunt the impact, which again we saw in 2020, is that people are mobile. Not perfectly mobile, right? It's a big ordeal to uproot your life, to take your kids out of school, to move away from your family and friends and go to a different state. That is tough. But when you see the kinds of tax impositions that are coming, whether it's California or whether it's the communist in New York City, that does have an effect, and people are going to leave.
Yeah, and I mean, and that's really that's a great point, and that's a great summary. Thank you. It really brings to light exactly where we have federal, state, local governments that should be working together for common goals: the safety of the citizen, the well-being of the citizen, the state, the country, the city, economic growth, prosperity for those that choose to take part and work and be a part of the growth. It's safety, it's prosperity, it's growth. And you have the state and locals working against the federal because they don't like Orange Man. And the citizens in these cities need to start, and these states need to start to understand that while the Democrats are playing politics time and time again, they're playing it with your family, with your money, with your children's future, your grandchildren's future. Look at what the policies are doing to your life, to your children's life. And you'll start to see how political they are, how dishonest they are. I think in New York, and you made a good point about the mobility, right? People, vote with their feet. They vote at the ballot box. They so on and so forth. I have a family that I worked very closely with for many years that literally owns billions of dollars of real estate in New York City. You can't move that. You can move to Boca if you want to, but how do you move that real estate? If it's commercial real estate, if it's residential real estate, and now they're going to cap what you can charge for it, which is part of Mamdani's deal, and they're going to jack up your taxes. Well, you're putting us in a position where you're putting investors and property owners, those that are actually the backbone of the city, New York in this case, you're putting them in a position where they're going to actually get to a spot where they could be belly up. And then what happens to all of those residences? Well, they become public housing. And we all know what public housing looks like. We all know how inefficient that is. We all know how unfair that is to have people stuck in that rut versus being able to work, prosper, and grow and eventually rent their way out of an apartment and buy something, buy a home, buy a house, buy an apartment, be a part of the American dream. They're taking it away piece by piece, and they're telling you to your face what they're doing, and you're voting for it. I don't understand it, and I am upset because I feel like the policies that I voted for at the federal level are being undercut, to your point and your explanation, being undercut at the state and local level. Nationally, it's a yin and a yang. We're fighting each other when we should be working together, and it's pure politics on the side of the left. That's just what I see. It's not my opinion. It's not what I feel. It's the facts being presented. So I would love to be proven wrong by people like Mamdani and Newsom, but they can throw Pritzker right in there. They continue to prove me right, which is unfortunate for us and for the country.
Yeah, Anthony, it's amazing how for the longest time there were various names for them. I think like Blue Dog Democrat, right? You had these different Democrats who might have been more aligned with the left on certain social issues, on things like abortion, let's say, but they were very good on tax policy. Jared Polis out in Colorado, I believe, he was really good on tax policy at one time, and he has completely abandoned all of those supply side ideas and now is just yet another tool. I hate to say it, but he's just yet another tool of the radical left. And it's amazing how if you're going to have a D behind your last name, it really feels like you just have to, in elected politics, that is, it feels like you just have to abide by anything and everything that's in the party platform. Whereas you can find Republicans today, I think, in elected office, some of whom are actually for like more progressive tax rates.
Yeah.
Right. I mean, that's not a conservative idea. That's not a supply side idea. That's the exact opposite of what Steve Forbes ran on when he tried to become president, where he wanted the famous flat tax. Right.
Yeah.
So again, it's just it really as if that diversity of thought has completely gone away. And I think that's been very detrimental, like you were saying, to all of the people and all of the businesses in those Democrat-run states. And unfortunately, you're right. What do you do when you have all those real estate holdings and you want to get out of New York? You got to sell it. That's it. And because everybody else is trying to do that too, you're selling at a discount, right? You're taking that haircut, which is obviously very, very unfortunate for those people.
Businesses, real estate, you name it, you're stuck. You're stuck. And the Democrat Party is a socialist party. There's no question about it. There's a lot of things about, I could give my opinion about people and how they have a negative 55 IQ, like AOC. That's my opinion. I don't know what her IQ test came in at. It's probably, low single digits. It's probably not negative, but if you look at policy, they're a socialist party. They're through and through socialist party, and they're a dishonest party. And I'm not saying that all the Republicans are true conservatives. And I'm not saying that all the Republicans are truly the people I want in office or are voting the way I agree or even voting the way they were elected to vote. I'm not. I think a lot of the Republicans need to get off their asses and actually get some of the executive orders codified and put us in a position to recover long term from the ditch we're in. However, the Democrats are way off the track. They're a leftist socialist party, and it eventually is going to burn in a way that we're not going to be able to control. And to your point, and then I'm going to move on to the S&P, to your point, the turning off of the spigot of the dollars coming from DC out to these states and cities who cannot control their budget and that cannot manage themselves. And you can put Newsom right at the top of the list. That spigot getting turned off is a big part of the visceral that we're seeing from these blue cities and blue states, because they were on a gravy train on a national tax dollar or the printing press, and that's getting turned off. And guess what? Their policies don't work. Their policies are not funded, and they're hurting their states. They're hurting their citizens, and that is hurting the country. I want to move to the S&P, and thank you very much for that, because you went into that far beyond anything I could have. We've been looking at the weekly chart in the S&P. I want to bring that up, and there's a couple of things to recognize here. I have a really pretty vertical line on the chart. That was the week of, again, this is weekly bars. That was the week of November 21st. That's when our momentum indicator, the MACD, is a basic momentum indicator that not as many people look at as should. Our momentum went negative. From that point, November through January, through today, we did hit new all-time highs up above 7,000. So that all-time high for the S&P, and this is the front month future. So this is not the S&P cash index, but it will mimic it. These are actually the generic front month futures, which we trade here, the futures contracts. You can't trade the cash contract, actually. It's just a number. We hit a high on Jan 30 at 7,043. That was the all-time high. So as we continue to grind at the top of a range, an all-time high range, and hit a new all-time high, what we're seeing is momentum has continued to degrade on a weekly basis. So this is more significant than the daily, more significant from an hourly chart, a 30-minute chart, a 2-minute chart. As you move out in period, you move up in relevance. And this is a pretty relevant intermediate to long-term chart. Higher prices, grinding near the top, lower momentum is a really bad signal. You can look at the same type of setup, ironically, back in December of 24, heading into 25, the tariff tantrum and those lows in April. Now, I'm not saying that that was foreshadowing the tariff conversation. What I am saying is the headlines are interchangeable. And back in December of 24, we were a little ahead of our skis. We double topped at 6,400 on the S&P. And you can see prior to the red momentum indicator here, if you look back on the last time it turned red with that big dip, that was the same type of setup. All-time highs, hitting our head, grinding along, momentum was fading. So the enthusiasm and the push higher was actually under the hood was less and less and less. It was decreasing as price was getting fluffed and fluffed and fluffed with less relevance, right? So something's got to give. Either momentum is going to shift up and catch up to price and we're going to explode out, or price will degrade, break down, and catch up to momentum and will bottom out somewhere, just like we did on the April lows. If we shift back to today, not only do we have this negative momentum or negative divergence between price and momentum, which is, again, extremely significant, we have what's called an ascending wedge. That ascending wedge are those two lines that are kind of, one is angled up a little bit more on the bottom, supportive. Then we have a resistance line on top, which is angled a little flatter. That wedge formation, where we're hitting our head at slightly higher highs, but those lows are kind of creeping up, but we can't break either way. So emotionally, the market is not able to break out to all-time highs, break out of this, what we're calling the 7,000 level right now. It continues to go down and press against support, and it continues to do that with degrading momentum. That formation is a very bearish formation, and it's actually about due to break if you're going textbook technicals. So based on price action within really this week through the next 3 to 4 weeks, we should see a break below that bottom support line, and that break should create what we call is a measured move down. Now, what's a measured move? Well, if the original formation is about 400 points, it's 430 points from the first peak to the bottom trough at the fat part of that wedge. That 430 should be flipped down, and that's going to bring us down to about 6,400, which ironically, if you look at that horizontal line, brings us right back to the highs, the double top in 2024 in December into January. So
now is that typical, Anthony, where that downward move that you're looking for returns you to the previous highs where you were hitting your head, or is that just coincidence in this case?
So it's not, I wouldn't say it's typical to previous highs. What I would say is in our analysis here, if we can find multiple inputs that bring us to a common level, it adds to how significant we think our thesis is and how significant that level is, right? So if we run a regression, we run a projection, we run trend line analysis, we run measured moves off of ominous formations like this, and they're all bringing us to 6,400, I'm going to say 6,400 is a pretty good spot. It makes sense. It's perfectly symmetrical. And that's kind of the way the charts work out. That's why this works. If you're looking at it the right way and your timing is okay and your sizing is okay, which we hope it is, fingers are crossed right now. I would say the more independent studies we can do that bring us to point A, the more valuable we think point A is, and the more valuable each of those independent studies are. So our thesis is here, we're going to break down. We're going to hit 6,400, 6,600 in the nearer term, 6,400 on a complete measured move out, and then we'll see how we're acting there. I'm not guaranteeing that that's the bottom, but I'm not doom and gloom. I'm just saying that is a good target. It's a significant target, and there's a lot of reasons to think that is where we'll end up as we work our way through this formation. So for now, that is the weekly chart for this week. I think it puts us in a pretty good position expecting downside moves. If you're long and you love your longs and you think we're going, to all-time highs, and that's fine. In my opinion, and in our work here, we are positioned and we are positioning for a move lower, and our downside targets are 6,600, 6,400 on the front month future. I would at a minimum be aware of the fact that this is a real possibility.
So, Anthony, I just find it so fascinating when you mentioned the wedge, because as a layman, right, I would never look at a wedge where both your upper and lower bound are both increasing over time and think bearish, right? I would think, okay, that's bullish. They're both going up.
Yep.
One obviously is going up more than the other, but eventually when you hit the end of that wedge, you're going to have to continue going higher, right? So I just find that kind of analysis so fascinating and so insightful.
Well, thank you very much. I appreciate that. And I think that it is somewhat counterintuitive that we have slightly higher highs and higher lows, and it's actually bearish. Now, what you'll notice is the momentum is fading within the wedge. That's extremely important. In fact, the negative momentum started when the wedge started. And what you'll also notice is of the past 3 weeks, this week included, the highs are not reaching that upper trend line. They're not getting to it to test it. They're continuing to test the lower trend line. So what does that tell you? The supply is coming down and getting less patient to wait for higher prices. The demand is getting less enthused and less willing to push it to higher prices up at the top, but they're meeting down at the bottom trend line. The pressure is coming down on top. And that's what the wedge formation is showing you. Emotionally, that's the formation. It's that it's top heavy and it is coming down. And at some point, again, relatively soon, I expect that support to get broken. Once that support gets broken and the buyer steps, and the incremental buyer at this point, by the way, is the retail buyer. The retail buyer is never first to the party. They're always last. And they always walk out with their pants around their ankles. So for a better way to say it, I think that the retail buyer being the one stepping in, and we have the data, like I'm watching this, we have the data from the street. Citadel's been out with it. BOF is out with it. A tremendous amount of research on the retail buyer being the incremental buyer. When that buyer olays, that bull is going to fall. And this is exactly what we're looking at right now, in my humble opinion.
Love it. Absolutely love it, Anthony. Thank you. That's, again, incredibly insightful, incredibly thoughtful.
Awesome. Well, thank you for the analysis on the economy and the undercutting of the Trump agenda by the local and states. At Real E.J. Antony, I'm on the handle all the time. I can honestly tell you I'm there multiple times a day just to check. And you produce a ton of content, by the way. I don't know what AI tool you're using, if anything. I think you are the AI tool, but ton of charts.
I wish I had an AI tool for doing this. It would make my life so much simpler.
I am at CMT_Anthony on X as well, if you'd like to check the handle. Ascalon6capital.com is the website. And if you want to reach out to me directly, that's absolutely fine. It's Anthony.Esposito@Ascalon6capital.com. EJ, until next time, my friend, have a great night. Tthank you so much. Always appreciate it.
Until next time, Anthony. Thank you.